And we are back. There is Helene. Helene, good morning. Thank you so much for joining us. It's really a perfect time to have you here because, Helene, when we look at the charts right now, I think a lot of people, it's always the eye of the beholder, right? Because you could see that we had the big move lower and now we've had a really decent move off the lows and we're kind of in the middle-ish area. And everyone's probably having this debate on whether or not the correction was over or we're back to kind of bull market, or is this just a bear market correction? What are your thoughts on the equity indexes right now?
So typically, I think what we had when we came down and we had the big whoosh, we had what I would consider panic. And after panic, you get a rebound. And after the rebound, we tend to get a chop fest where people have this, should I, shouldn't I? Is the rebound good? Is it a new bull market again? Is it always just before we go back down? And so that's where you tend to get a chop fest. And the chop fest can last weeks. Quite frankly, I've seen it last months, and I never seem to know which it's going to be. Right now, I just know that I think we're headed into some kind of sideways pattern while the market works off the overbought condition from the rally over the last couple of weeks.
Before I get to Shai, because I know Shai's got some questions for you. So when we get into this pattern, what are some of the indicators that you look at to help us navigate what you think the next leg of this move is?
Okay, a few things. First of all, we're short-term overbought. So we've got to work that off. And for my work, it's not usually price, but time. And that basically means a week or two of working that off. That's number one. Number two is I've got an intermediate term overbought and oversold oscillator I use. And my calculation, and this can change, but my calculation is sometime mid to late May, that gets overbought. Then the last thing I watch is sentiment. How fast did people get bulled up off of this move? And if people get bulled up too quickly, I'm fond of saying that when it comes to sentiment, think of two neighbors side by side with a fence in between. The bulls are on one side, the bears are on the other side. And sometimes the bull party gets really loud and raucous, and the bears get so jealous they jump the fence and go into the bull camp. And that's when you get too much. And then the opposite happens. But the majority of the time, what you get is they sit on the fence. They don't necessarily jump the fence. When you jump the fence, that's towards the end of the move. And so right now, I think there's a shift where, let's just say, the bears are sort of moseying over to the fence and they're sitting around, oh, should I get on the fence? Should I not get on the fence? So one of the signs I'll look for is, do the bears jump the fence? And typically what happens is you get a sideways move and then you get another try upward. And let's just say we get a sideways move for the next, I don't know, week or so, and then you get another move up. That's usually when you see them jump the fence because, oh God, they're not coming down again. And then you can assess what's going on. My guess is, since I anticipate getting intermediate term overbought in that time frame, my guess is once you get everybody back on board, then you get another run.
Yep.
Yep, absolutely makes sense.
I'll tell you, for the longest time, first of all, I turned bullish on bonds like in January. It was all right for a trade, and then it's gotten quite rocky. I thought if I used the TLT, I thought after that initial rally, we would mostly be in a range of 88 to 93. Then we fell out of the 88, but we recaptured it fairly quickly, and we're back into it. And so I'm still going to stick with the fact that I think the bonds are just in a giant trading range. I heard you guys say that the interest rates are where they were, I don't know, a couple of months ago. Quite frankly, they're where they were a year ago. They're where they were in the fall of 2022. Interest rates haven't made a lot of big moves. We've moved up out of the range and we come right back down like a magnet. We move down out of the range, we come right back into it. And to me, right now, I don't see much changing out of that wide band.
That makes sense. And then what about energy? Because I know you also look at XLE, and obviously I follow the energy markets very closely. So I want to know what you're seeing on the technical side.
Well, as you know, the stocks act garbage, like garbage. That's a technical term. But I'll take it. What's caught my eye, though, is I like to follow sentiment, the daily sentiment indicator, the DSI, which is a service I buy. And for those who don't know, it ranges from 0 to 100. And when it gets to single digits, you want to be bullish. When it gets over 90, you want to be bearish. And then you've got these ranges under 20 and over 80, where it's sort of get ready to be on alert. And sometimes you don't really get to single digits and you don't really get over 90, but you got to get ready to look for a change. And last night's DSI in crude oil was 20. So the way I look at it is, while I don't like the charts and I don't like crude oil here, I have to be alert that if we get much more weakness in crude, I'm going to have to start looking for reasons to like it for a trade.
Gold just made a big high. We had some news that took it off of that high. The whole world's kind of looking at gold. What's the next move? What do you think?
Okay, so I'm going to go back to that DSI. And I've been waiting for the DSI to get over 90 in gold. And all it did was knock on the door several times. Last week, we got to 88. Again, so you look for some kind of a correction when you get to 88. You get over 90, it's much more bearish. And I know this sounds like a distinction without a difference, but I've been following this DSI forever. And it takes so much to get that reading over 90 or to single digits that it really is incredibly extreme when it gets there. So at 88, you got to look for a correction, which I did. It's back down to 74. So right now, I think gold is just neutral. I wouldn't be super bearish on it, but I'm not thinking it's ready to be bought again. So I think, when I look at the stocks, okay, I think the stocks have lagged gold itself, which is sometimes a tell, but the stocks are up near a resistance. They're up near a measured target. And so I'm more in the camp that gold needs an extended correction. I don't really have exact levels on it, but it got bought yesterday. Maybe today it gets sold. Maybe tomorrow it gets bought. That, and over time, a pattern should develop that maybe what happens is you had that big move up, you come down, and maybe a few weeks out in time, you're like, oh, all right. Gold starts to look all right. Everyone seems to have forgotten about it by now. And now maybe it can go up again. But I need that digestion or that topping. All I know is last week we got to see too much on the upside. And now we're in no man's land, really. And I just want to go back to a point that you made about how we get so narrow focused and we look at what happened yesterday or today, and we forget to look at the big picture. I'm fond of saying that traders are like teenagers. We all want instant gratification, only the real world doesn't usually give it to you. So we should really stop focusing on that instant gratification, even though, God, it feels so good.
Helene, this was great. Helene, you're the best. Shai, tell her.
Thank you. We love you, Helene. Of course, we hope to have you back again.
Have a great day.
This presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader, LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.